You know, it's been hard to build in Los Angeles for a while, for over a decade, for a long time, right? We started the slow growth movement in the 80s, and we've continued making it harder to build ever since. But other cities are catching up. It's getting harder to build in Houston than it used to. It's getting harder to build in Atlanta and in Phoenix and in Las Vegas. And a lot of these cities find that they're running out of land that's easy to build on. I don't mean to say they're running out of land, they can always expand, but the land that people actually want to live on, the land that the city will let you build on, is dwindling. And that means that those kinds of cities are starting to catch up to the problems that we've been experiencing here on the coasts.
This is Maestro Minute, the show that discusses all things real estate, sharing interviews with the most successful people in the industry. Hear from their perspective and what they are doing to achieve success. Get exclusive tips on how you can also succeed in real estate. Maestro Minute is brought to you by Maestro Development. Here's your host, Nareg Muradian.
Hey everybody, welcome to another episode of the Maestro Minute. I'm your host, Nareg Muradian. Thank you for watching this episode. I think you guys are going to enjoy it. If this is the first time you're watching, please make sure to like and subscribe so you can stay in touch with all the content we're putting out. Today, pretty excited about our topic. We're going to talk about finance, we're going to talk about real estate, and we're going to talk about public policy. All great things that really push the pendulum in real estate and development. Excited today to bring on Dr. Anthony Orlando. Good to see you, Doctor.
Thank you. Thanks for having me.
Thanks for coming.
Yeah.
Before we get too deep into it, let me do a quick intro.
Okay.
And let me know if I miss anything, because there's a lot of good stuff in here.
You can do the short version.
I'll do the highlighted version? Okay. So currently you're an associate professor at California State Polytechnic University, Pomona, Cal Poly Pomona, in real estate finance and law. You hold the title of Singleton Fellow of Analytics in the College of Business Administration. You're a visiting scholar at the Federal Reserve Bank of Atlanta.
Yep.
I would love to hear more about that. You're serving a Public Finance Authority Board for Laverne, an Enhanced Infrastructure Financing District. So those are all great things. You're teaching and conducting research at the intersection of finance, real estate, public policy, all things we're going to touch on today. Yeah. You've published a dozen articles in top economic and finance journals, Cambridge Journal of Economics, Energy Economics, Real Estate Economics, Journal of Real Estate Finance and Economics. Your book is pretty cool.
Thanks.
I started reading it, I haven't finished it, but I think we talked about it last time we met. So if you guys get a chance, please check out Dr. Orlando's book, Keeping Races in Their Places, The Dividing Lines That Shape the American City. Your career path is, we talked a little bit before the camera started. You got your bachelor's in economics from Wharton School, University of Pennsylvania. Then you went to London School of Economics and got your master's there. And then you got your PhD in public policy from University of Southern California. You're a CFA chart holder and member of CFA Society of LA.
Yep.
Did I miss anything?
No, that's all the good stuff.
That's a lot of busy work, right?
Yeah, I try not to be bored.
Yeah. So that sets the baseline. So let's dive a little bit deep. Today we're going to talk a little bit about Fed policy, offices in downtown, what's going on downtown, taxes, where we're at, affordability as it relates to housing, talk a little bit about real estate development, property insurance, which is, out of this world right now, and then institutional investors. Those are all great topics. I did get a few questions from some viewers that we'll have at the end.
Sounds great.
But I think it's kind of cool because we're filming this in June, end of June, and it's kind of a mid-year economic thing, right?
Yeah.
Where we're going, where we're heading. So before we jump into this, where is the economy currently in the U.S. and how do you see it, kind of on a high level, where we're heading? What's the climate of the economy in the U.S.?
Yeah. It's kind of funny because the economy is strong if you look at all the fundamentals. And we've got inflation coming down. It's pretty close to what the Fed's target is. We're expecting that on Friday, the PCE, which is the main measure that the Fed uses to measure inflation, will probably be around 2.6, 2.5%. That's pretty darn good. The economy's continues to grow even with high interest rates. We've had good jobs numbers.
Inflation is targeted at 2.6%?
Inflation's targeted around 2 to 3%.
Currently. So it's gone back down.
So it's gone down, and it's
Okay.
down around 2.5% now. And it depends on what measure you use, and we can come back to that.
Yeah.
But the measure that the Fed uses, we expect will be about 2.6. That's kind of what experts are expecting. That's come down a lot in the last couple of years. Gas prices have come down a little bit in the last few months. Jobs, like I said, the jobs reports have been good. The economy is growing really well, and yet there's a lot of discontent. So one of the things that a lot of economists are trying to figure out is why so many consumers seem to be unhappy with the state of the economy when, by all these measures, low unemployment and everything else, it's doing better than it was doing a year ago, 2 years ago, 3 years ago, 4 years ago. So it's in an interesting place. I would say that quantitatively, the things we can measure look good, but people obviously wish that it could be doing better. And I think if we're looking forward, there's a lot of risks that could bring that down. Economies don't keep growing this beautifully forever.
Right.
So there's a lot of problems that could emerge over the next couple of years.
Okay, great. No, that's great. Exciting to hear that. So that kind of gets us into our first question about Fed policy.
Yeah.
So next couple of years, how do you see Fed policy affecting the economy coming up in the end of the year? Obviously, it's an election year, and then next year or so.
Yeah.
You brought your crystal ball with you, right?
Right, of course. Everything I say will come true. No, not at all. So we do our best. I always say that, the famous story, Irving Fisher, one of the famous economists from the early 20th century, he used to go to dinner parties and people would say to him, what's going to happen to the stock market over the next year? And he always said, it will definitely fluctuate.
Yeah.
That's about all we know for sure. But hopefully our educated guesses are better than nothing. And the way I like to think about it is, if I can give you information that's useful, even if I can't predict everything, you can take that information and plug it into your business model. Helps you make a little more sense out of what to do with your business going forward. So from a monetary policy standpoint, like I said, inflation about 2.5%. Now, one question we can ask is whether we actually trust that number. I think that the government does a good job of measuring inflation. I don't want to cast doubt on their measure per se, but it is a backward-looking measure. It tells us how inflation has been doing.
So there's
over
a
the last
lag,
month.
right?
Right.
Yeah. Right.
And so what you really care about.
What's the lag? Is it 2 months or?
So I mean, they can get up to a month ago. They can tell us how inflation has been doing, but they can't tell us what's going to happen over the next 6 months or the next year. So what you really care about if you're trying to set monetary policy is what's going to happen in the future. Because if I change interest rates today, that's going to affect economic activity months from now, right? It doesn't affect anything that happened in the past. So I like to look always at a measure that some folks at Penn State have put together. There's a couple of professors over there. There's also a professor in our backyard here who's a part of that team, Ed Colson at UC Irvine, who's a good friend of mine. And they have put together a measure of inflation that's a little more forward-looking. And the way they do it is using real estate. You and I have talked a little bit about this measure before. You've seen me show these graphs. I like comparing theirs to the official government measure because what they do is they take the housing component of inflation, which is a huge chunk. It's about 40% of inflation is housing costs. And they say the problem with the way that the government is measuring inflation in the housing market is they're asking people across the economy, how much are you paying? But that doesn't tell you how much it's going to change. To do that, what you want to look at is new leases, people who are getting new apartments. How is the rent changing when they get a new contract? Because you might be paying a lower rate or a higher rate because you got locked into an apartment 6 months ago. Well, what I want to know is the people who are signing the contracts today. So they change to that measure of new leases, so they get a better forward-looking measure of rent. And their estimate of where inflation is closer to 2.2%. So I think based on that evidence, it's fair to say that the economy has cooled down enough that the Fed doesn't have to worry about inflation like it did a year ago. I think the Fed knows that for the most part, but they've been reluctant to reduce rates yet. They've just been keeping them steady. The last measure that came in inflation was the CPI numbers a couple of weeks ago. And it was right before their last decision. And they made the decision to keep rates the same. The CPI came in better than what they were expecting, but I think they want to be more cautious, and they'd already made up their minds, and so they weren't going to cut rates. I think if we continue to see good news, where inflation keeps coming down over the next month or so, then the next big decision they make will be September. I anticipate they'll cut rates in September. We could also see another cut later this year. So I think it's reasonable to expect a couple of rate cuts by the end of the year.
What's triggered the inflation numbers to go down? Like, what's the root of that? Is that just increased? Like, obviously, it's very complicated, but is that increase of supply, to meet the demand, and however that works, or what have you seen help, from a economic standpoint for that?
Yeah, I think it's a combination of an increase in supply and a decrease in demand, the two major things that would drive prices down. There's been a big argument throughout the pandemic, what was really driving inflation? Was it supply or demand? It was definitely a combination of the two, because on the one hand, you had a major supply chain crisis. That makes lots of things more scarce, and scarcity drives up prices, right? People have to compete for scarce goods. They try to outbid each other. That's just the way that capitalism works. So that supply chain crisis has abated over the years, and we're starting to see that prices are moderating as a result. The other thing that happened in the pandemic was there was a lot of government stimulus money that came through. Now, part of that was for a good reason. It was so that we didn't repeat the mistakes of 2008 and 9 when we didn't have enough stimulus and we wound up in a really long, extended recession and a very slow recovery. So this time they went all out and we had a surge in demand. Most of that money has been, if not spent, at least allocated. And when you look at the GDP numbers, the gross domestic product numbers, they show you how much of the changes in GDP is due to government spending. And during the early years of the pandemic, it was a big boost. And now it's actually a drag on GDP. So it's pulled demand back. So it's a combination of an increase in supply and a pullback in demand.
My wife last night, I told her we were meeting, and she wanted to ask you about, I hope she doesn't mind, but discretionary income or discretionary spending.
Yeah.
How is that tracking? Obviously in a capitalistic market, you have the Amazons and everything is like instant gratification. That spending is still occurring. I think it's slowed down in retail, but I guess how is discretionary confidence right now in the U.S.?
Well, this is another one of those areas where the numbers are good, but the sentiment is not as good. So it's interesting. Consumption growth is pretty strong. People are continuing to spend like they have. Now, some of that is because income growth has grown pretty well, and some of it is because debt has grown pretty well. So credit card bills have piled up too.
Right.
I don't think they're anywhere near a level that we should be concerned about a financial crisis or anything. Historically, they're not at super high levels. But as credit card debt continues to pile up, at a certain point, you do worry that consumers will, over-leverage themselves. So that has enabled people to continue growing their consumption. At the same time, those consumers don't seem to be reporting that they're as confident in the economy as you would normally expect for times like this when consumption is growing.
Well, and I keep hearing there's two economies, right? There's the Wall Street and the Main Street, and there's that disconnect, right?
Yeah.
And that's, I think, a problem that a lot of people are having to address. How do you address those different entities?
Yeah.
And then back to inflation. Inflation is tied to, the interest rates are tied to inflation. So now that you see the rates coming back down, what is your forecast on the rates?
Yeah, like I said, I think we'll have a couple of rate cuts later this year. I also think that there are a number of risks out there in the global economy that can slow down the economy. It's not going to, we have had record low unemployment numbers for the last year plus. That can't continue forever. At some point, the economy will weaken for one reason or another, and we can talk about the reasons why. But when that comes, the Fed will have to lower interest rates. Now, the interesting thing is the bond markets actually seem to think that interest rates are going to stay high for a while. They are predicting that the long-term interest rates over the next 5 to 10 years, medium-term to long-term, are actually going to be higher than what the Fed is saying they're going to be. So they don't believe the Fed. The traders in the market say to the Fed, you say you're going to get interest rates down around 3 or 4% from where they're at now or even lower. We don't believe you. So There's plenty of people out there who don't think the Fed is going to lower rates. I don't think rates will stay as high as they are right now.
Yeah, I hope so. I feel like there is a pent-up demand that's building.
Yeah.
And they're waiting for rates to be addressed, especially in real estate, right?
Yeah.
Which leads us to kind of the high vacancy rates here. We're in downtown LA, a lot of vacancy. Let's talk about that real estate and offices in downtown.
Yeah.
What's your perspective on that?
It's a terrible market. There's no question about it. Right now, the official vacancy rate in Los Angeles, according to CoStar data, is 16%. Now, that's for all of Los Angeles. It's much higher in the downtown
Yeah, I
right
think
now.
in downtown I heard it's closer to 30%, right?
I've heard numbers like that too. It's hard to pin down, but that
So
sounds
all of Southern
in the right
California,
ballpark.
LA County is 16%?
16% for the whole LA market,
I see.
extending out into the San Gabriel Valley and everything. But there's big differences between the submarkets. So you're hearing numbers like 30% in downtown. I think that's a reasonable estimate. What I'm hearing from brokers out in the San Gabriel Valley and out in the Inland Empire is that vacancy rates are super low, that those offices are still being used. Maybe it's because those offices are closer to people's work, so they don't have to do the commute. And here, if they're only coming in once or twice a week and they're now able to work from home, why come in as often as you used to? And so these ones are empty more often. So there's big differences. When we hear about an office crisis, some areas are in crisis and some areas are not. It's not like the entire portfolio of offices are going to get dumped in the next year. There's been a concern that a lot of banks, especially small to medium-sized regional banks, have portfolios that are heavily concentrated with offices, and that's going to cause some kind of a crisis. I don't think that that's the case. I think it's entirely possible that you could have a bank here or there who makes mistakes, like last year we saw Silicon Valley Bank and Signature Bank. Banks go bankrupt. But for a banking crisis to affect a huge chunk of the system, I just don't see that happening. Part of it is because I think that offices will rebound over the next couple of years, and part of it is because not all offices are underwater.
I thought I would be seeing more of this, and it hasn't really happened a lot, are the office conversions, the different types of products, right? What is your feedback on that? It's
so much harder than most people realize. You know, you have an engineering background. You know better than most how hard it is to do these kinds of conversions. So first of all, you've got very different kinds of office properties out there. The older buildings were built very different than the newer buildings. And for anybody out there who's been in a modern office building, what you would picture is you step out of the elevator and you see a big open floor filled with cubicles, right? And then along the walls, the exterior walls, you just see big glass, right? Big glass windows, letting lots of light in. Very nice. That's not the way that we built office buildings 50 or 100 years ago. Go watch some old black and white movies and see what the offices look like in an old film noir movie, right? They were much more compartmentalized. They were smaller footprints. They often had a light well down the middle of the building because they didn't have a lighting system that could easily light everything, so they needed natural light, and that meant you needed more window surfaces. Those older buildings are easier to convert, because when you want to convert a building into apartments, you need more natural light. Most cities in their building codes say that you need at least one operable window per apartment. And it's helpful to have it compartmentalized already like that. You also need to completely restructure the plumbing in an office building. If you've got that big office floor plate that's all cubicles, how many bathrooms are there on that floor? One set of bathrooms, right? It's probably somewhere in the hallway near the elevator, and everybody uses that. But if we want to compartmentalize that and turn it into multiple apartments, we now need to run pipes through the whole building for all those different units. So when you run the math, you find that converting newer office buildings to apartments is extremely difficult and expensive. And that's not even getting into the legal and regulatory constraints that you might need to do, rezoning, getting public approval, et cetera, et cetera. I just released a new paper with the Federal Reserve Bank of Atlanta that just came out last week, where we tracked large construction projects across the country to see how long they take from the moment when the developer first says they're just planning the building all the way through construction to the end, to see, is it taking longer to build than it used to take? Does it take longer in LA than it takes in Atlanta? Stuff like that. One of the things we could do is compare new construction to conversions. One of the things that people expected is that if you do a conversion, it'll happen a lot faster, right? You don't have to build the building from scratch. Not so. The construction might be a little faster, but the planning phase often takes longer than new construction. As a result, you really don't gain any extra time. Conversions are hard to do. They are happening, but they are mostly happening what I would call the low-hanging fruit. The buildings that are easy to convert, and most of the buildings that are out there in our office stock are not easy to convert. And the other thing that makes it easier to convert them is if the owner of the office building has the financial capacity to do that. A lot of the owners of these buildings, they're highly leveraged. They're trying to pay off mortgages. They can't take on more loans on top of that in order to do the conversion. The ones who are doing the conversions are often the ones who are free and clear of debt. And there aren't that many of those owners out there.
I know from our experience, there's like a 30% cost increase for infrastructure upgrades, exactly what you mentioned, above and beyond the standard tenant improvements, you know? Do you think that either federal, local, or state will get involved and try to subsidize some of that to help?
Some of them have already.
Right?
Some cities have already adopted programs like that. Yeah, and I think the reason why they're concerned about it is not just because you've got empty buildings, right? That's not by itself, I mean, it's sad for the owners, but just for the owners. Who cares? The reason you care about that is because those buildings create an ecosystem, a local economy that other economies then depend on. You know, when people don't come into the office and that building sits there vacant, where goes the lunch crowd for all the restaurants that are around there? Now, if you fill that with apartments, suddenly you've got people who are living there all day long, especially if they're working at home, and they can frequent those restaurants. So I think a lot of city leaders are concerned about those spillover effects, and they're trying to calibrate what's the right level of subsidies to give. But, you know, it's hard. City budgets are stretched thin. They've got so many other things to pay for. Is this really the best use of taxpayer dollars? I'm not sure that it always is. That money might be better spent building housing for the homeless or improving public transit or a million other things.
Do you think that the state or the feds will get involved in that process? Or
I think some of the states already have. The feds, it's harder to do. HUD is a tricky entity because they, unlike a lot of the other cabinet departments, they're trying to affect local policy with federal resources. You know, if you look at health and human services, when the federal government gets involved in healthcare, they can adopt programs like the Affordable Care Act, Obamacare, and they can establish policies that affect the entire country and change the healthcare market. If you want to change the housing market, you have to go city by city and drop different incentives in their laps to try to change the way all of these policymakers govern their cities. They do it, but it's slow moving.
So that leads me to our next item here on affordability of housing and the lack of affordability, especially here in California. Where are rents and prices, and where are they growing, where are they declining? Where do you see that market going?
There's a terrible affordability crisis. We all know that. It has spread. So it is no longer just in the large coastal cities. It used to be that if you talked about an affordability crisis, you were mostly talking about New York, San Francisco, Los Angeles, et cetera. During the pandemic, we saw prices surging all across the country. This is not new, though. I just released an interesting new paper with a colleague, Chris Redfern at USC. We published it in Real Estate Economics, and we were comparing all the major cities in California to Texas. And the reason we did that is because California and Texas are light years apart in terms of politics. So we thought, here's apples and oranges, and let's see whether they really have very different housing markets as a result. And what we found is that they're actually a lot more similar than you might expect. From 2014, long before the pandemic, to 2021, which we kind of defined as the last big housing boom that we saw, the trend lines in all those markets overlapped. There's no big difference between California and Texas. Now, that wasn't true in the boom before that. When we had the so-called bubble in the early 2000s, prices soared out of control in Los Angeles, and price appreciation was pretty muted in Texas. Now, those lines are right on top of each other. All of these cities, Houston, San Antonio, Sacramento, Los Angeles, all are acting similarly, which means something is changing so that this has become a national crisis. And the thing that's changing is it's a supply problem. And the supply problem is no longer just Los Angeles' problem. You know, it's been hard to build in Los Angeles for a while, for over a decade, for a long time, right? We started the slow growth movement in the 80s, and we've continued making it harder to build ever since. But other cities are catching up. It's getting harder to build in Houston than it used to. It's getting harder to build in Atlanta and in Phoenix and in Las Vegas. And a lot of these cities find that they're running out of land that's easy to build on. I don't mean to say they're running out of land. They can always expand. But the land that people actually want to live on, the land that the city will let you build on, is dwindling. And that means that those kinds of cities are starting to catch up to the problems that we've been experiencing here on the coasts.
Yeah, they also have a capacity issue. They can only do so much workload, right? And they only have so many people. And I think there needs to be a spur in government hiring to help release some of that capacity. You know, in Los Angeles, there's a lot of, you know, city workers, but I'm curious on what your research showed on how long it takes in LA to get a project from, you know, beginning to end. You know?
Yeah, it's gone up over time.
Right? And you can pay it. I know on our projects, like we look at paying expediting fees,
Yeah.
which will help, but you know, you might lose that saved time on something else down the road. You know, so
There's a bottleneck in city planning, right? And I don't mean to call out the planning departments. In all of the approvals process, I'm just using planning as a general term. There's a bottleneck.
Right.
And it's not necessarily their fault because, like I said, city budgets are stretched thin, so they can only hire so many workers. But one way that we were able to detect that bottleneck was when we showed how the time to build changed over time. We went back to the mid-2000s, and then we ran the clock forward. How long did it take to build something in 2007, 2008, and so on, all the way up to today? And yes, it's gone up over time. But it actually went down after the Great Recession. Projects got built faster in 2010 and 2011 than they did in 2008, and then they did in 2014. Why? That looks like progress for once. Why did it suddenly become easier to build faster? It's because it's the same time when prices had collapsed and production had collapsed. People were sitting around at their government offices with nothing to do. Of course they could approve projects faster. So that's how we know that when the market gets hot, there's a bottleneck there. When the market weakens, we can actually build faster.
I'm curious, what's your perspective economically? What's the rent control perspective from an economic standpoint, kind of on a macro level?
On a macro level?
Yeah.
I have to think about rent control macro. It's so different city by city. I think the macro issue is that rent control is spreading, right? It used to be that rent control was only a few cities across the United States, but in the face of this affordability crisis, lots and lots of cities have been adopting new rent control statutes. And when I say rent control, we should be clear that what we mean by rent control in this latest generation is really more rent stabilization, which means you regulate how fast owners can raise rents, the percentage growth. It doesn't mean you put a hard dollar cap on it. So just so we're clear for everybody out there. But that's an interesting way to tackle the problem because it doesn't tackle the fundamental underlying problem. It'll help some people, absolutely. I've done some work on rent stabilization recently, and we've looked at the numbers, and there are lots of people who are living in rent-stabilized units who are paying lower rents than they would have otherwise, and that's great for them. However, the underlying problem is still a supply problem.
Right.
At best, rent control is only helping a small portion of the population. And the problem with the way that rent stabilization is designed in places like Los Angeles and the rest of California is that it has a feature called vacancy decontrol, which means that if I leave an apartment and you move into that apartment, you're a new tenant, the landlord can now give you market rate rents. There's no control over what they charge you. They can charge you the sky's the limit. The only thing that benefits you is the longer you stay in the unit, the more you benefit because the percentage increases are capped. But the moment you move out and somebody else moves in, they raise it right back up to market rate. And so there is some good research showing that a lot of people barely benefit from rent stabilization because of that way that it's designed. You have to live in the unit for many years before you really start to feel a benefit, and most renters move every year or two.
Right. Well, from a development standpoint, if you have rent control, it's harder to make the profit margins and pencil out, right?
Yes. And so there are a lot of studies on this that show that when rent control is put into place in cities, we tend to find that landlords cut back. They spend less money on their buildings because if I'm going to try to maintain my profit margins and you're going to cap the amount of rental revenue that I can earn, simple, I just won't maintain the buildings. I'll just let them deteriorate. And so housing quality goes down. And there's a lot of negative side effects. Now, I have a lot of friends who support rent control, and it's because they're stuck in a situation where they can't come up with a better policy because we're not building more housing. But if we could build more housing, we wouldn't need to resort to these sorts of policies that also have negative side effects.
And then getting into real estate development, I know we talked a little bit about that as it relates to rent control, but why is development different now than it was before?
So part of it, like I said, is that the amount of land that we have to build on is dwindling. That makes it a lot harder. Let me start with that story, and then we'll layer some government problems on top of that. The story there is, if you want to expand your city and build more housing, the easiest way to do it is to go out to the suburbs, find a piece of greenfield land, throw up a wood frame structure, and you can build at scale. You can build thousands of houses that way. That's the way we built most of America, right? That is the easiest and the cheapest way to do it. But eventually, you expand as far as people are willing to commute, and now you've run out of that green field. So what do? You start to turn back inwards. And so what we found in the research that I did with Chris Redfern, we started looking at where are new units allocated over time. In the 70s and 80s, the new units were allocated out in the periphery. In LA, San Gabriel Valley, Inland Empire, up in the San Fernando Valley, right? As we moved towards the 90s and the 2000s and the 2010s, we started to see more and more new units being added in the core. We started to see more and more units being added in denser neighborhoods. Denser meaning there's already a lot of units there. That's what we call infill development, as you know. The problem with infill development is it's harder to do. You have to try to sandwich a building in between other buildings. You have to try to find the few vacant lots that exist, and those vacant lots aren't necessarily big and easy to build on. They might be carved into a weird shape. You might need to do land assembly where you need to take that piece of land and assemble it with another piece of land so you can get a big enough piece of land to build on. And that means you need to pay out two different landowners who might drive the price up on you through the bidding process. All of that makes it more expensive. And it also means that the only way to add significant new units to the city is to build multifamily housing. So now you're building apartment buildings rather than those single-family structures, which have a higher construction cost per square foot because you have to do things like using either reinforced concrete or steel structures. You have to put in elevators. You have to change the way the plumbing works so that it can go against gravity much taller. And in a separate research that I published with my friend Mike Erickson over at Purdue University, we took the construction data from RS means and looked at exactly how it changes for buildings of different structures. And when you build those tall buildings, the cost per square foot goes up significantly for those reasons. Now, that doesn't mean we shouldn't do it. We should do it because it's the only way to add the units that the city needs. But it means that new construction is going to be more expensive no matter what you do than the way we used to build it in the past. We took for granted how easy it was to build in the past. Then you layer on top of that the fact that the process of getting approved to build anything has just gotten harder and more uncertain, riskier, and more time-consuming over time. We have layered regulation on top of regulation, and it's not just one political party. There are liberals who have put regulations in place to try to protect the environment and people's health, and a lot of those are very positive. There's also a lot of conservatives who have put regulations in place because they wanted to segregate neighborhoods and keep certain groups in certain places, and that's what my book is about, that unfortunate part of our history. All of this has resulted in this patchwork quilt that is just mind-boggling. When I teach my students about some of this stuff, I'll show them flow charts that the city of LA gives to try to help people do development. Okay, do you have this kind of building or this kind of building? Then go here. Okay, well then you need this kind of approval or that kind of approval, then go here. And before you see it, it becomes this maze, this labyrinth to try to just figure out how do we get a project approved? It could take years and years and years. And it has gotten, lots of evidence has shown this, it has gotten more and more onerous over time. that's only going to drive up the cost of development.
Yeah, 100%. I think here in downtown, you saw a lot of development go up, but some are just stuck in the water. You know,
Yeah.
they've stopped developing.
Yeah.
Let's talk a little bit about insurance.
Yeah.
Premiums have kind of skyrocketed.
Yep.
What's going on with insurance premiums?
Yeah, and it's not just premiums. So let's be clear that when we say insurance costs, if we're going to measure it correctly, we've got to measure the whole bundle of ways that people can be charged for this stuff. You know, insurance companies are clever. If they don't want it to look like premiums are going
Yeah.
up too fast, they'll just increase your deductible. So there's less that you're covered for, right? They'll reduce your coverage or they'll change the provisions. And so all of those things are changing to make the cost of insurance go up. Part of it is because of rising costs, right? They're worried that as construction costs increase, land costs increase, if they're going to have to come in and cover costs in the future from some sort of loss that the building has, they're going to have to build something new or renovate the building. It's going to be much more expensive than it was in the past. So the affordability crisis by itself creates an insurance problem. But the real problem in places like California on top of that is the changing climate, right? We've got wildfires are happening more frequently and are more severe than they used to be. In Florida, it's hurricanes. All across the country, natural disasters are becoming more frequent and more expensive. And so you're finding there are more and more neighborhoods that insurance companies are just saying, we want nothing to do with this neighborhood. Or if we are going to insure it, we're going to raise the rates dramatically. It's a very difficult business to try to predict the future in the way that property insurers have to do. And they have to make sure that they're going to stay in business. So they are obviously going to have to charge enough so that they have money in the bank when it comes time to cover those losses. And last year, the Office of Financial Research, which is an arm of the U.S. government, did a report where they had a sentence in it that I loved. One of their main findings was, look, companies aren't raising the costs just because they want to, just because they can, just because they're trying to charge people more. It's not just that they're greedy. Hey, corporations have always been greedy. What's new about that? They are doing this because their losses are going up.
Right.
Their costs are going up.
I know with our business, I'm always talking with our insurance team, and it seems like a lot of insurance companies are actually leaving California because of the costs, right?
Yep.
Do you see that ever coming back to like planet Earth? Like, you know what I mean?
I think they have to. So I think the insurance regulators in California are aware of that, and they're starting to make a shift. They recognize that it is one of the hardest states in America to do business as an insurance company. And I think, look, as much as they might love to regulate insurance companies, they're not so stupid as to just let all of them leave. They will ease up. And one of the ways we know that is that the insurance commissioner announced a couple new regulations just this year, I should say deregulations, to try to bring some of those insurance companies back. One is that they have tried to streamline the process to make it easier and faster to get your rates approved. So part of the reason why California has been hard on insurance companies is because those insurance companies need to get the regulators to approve the rates every year. I mean, imagine if you were running, a store down on the street there and you had to go to the government to approve your prices every year. That would be crazy. That's the way insurance companies operate here. They're not going to get rid of that, but they say they're going to make it a lot easier to approve it, and that'll speed things up, and hopefully they'll approve more of them. The other thing that they're going to do is they're finally going to allow insurance companies to use catastrophe modeling. California is the last state left in the United States who has not allowed insurance companies to do catastrophe modeling. Catastrophe modeling is where you're allowed to use both historic data and your projections for future catastrophes that are just basically estimated guesses. But the reason that's valuable is because, especially in a world with climate change, the future ain't going to look anything like the past. You can't just rely on historic data. You have to make some guesses about the future, and that probably means you're going to guess that it's going to be more expensive and rates are going to have to go up higher. But once they can use catastrophe modeling, hopefully more insurance companies will be able to justify, well, I shouldn't say hopefully, they'll be able to justify higher rates. Hopefully that means that people will have the options of more insurance policies, though. That's the silver lining.
Let's talk a little bit about investment.
Yeah.
Institutional investors and the housing market.
Yeah.
Where are we at on that?
So this has been a huge shift ever since the end of the Great Recession. Institutional investors, and by that I mean Well, a lot of people who don't like them will call them corporate landlords,
Yeah.
right? Big companies, Wall Street firms. Could be private equity firms, could be REITs. REITs tend to be publicly traded real estate investment trusts. These big companies have been buying up single-family housing across the United States. It used to be that we knew we had large landlords in multifamily because who can afford to build a 20-floor structure? It's going to be a big investor. But why would the big companies be buying up one house at a time? There aren't much economies of scale in that. That has changed for a couple of reasons over the last 15 years or so. One reason is because of technology. Technology has made it easier to scale up that business. Now a property manager can manage hundreds of single-family homes throughout an entire region, and they don't have to visit each one on a regular basis. They can set up different types of technology to monitor what's going on, and they can have a centralized system that every tenant can log into when they need maintenance. Your pipe bursts? Great. You want to tell the landlord? File this right here, and within 12 hours, we will have a truck at your house solving that problem. Not every company works that well, but the better ones, that's what they're doing that tenants seem to like. And we've heard a lot of good customer service experiences from the companies who've made those technological advances. The other thing that's changed is the affordability crisis. It started with foreclosures. We had all these properties that people had bought during the housing bubble in the early 2000s. They got kicked out of through the foreclosure process. They're sitting on the market as distressed properties, and Wall Street realized this is our chance. We can gobble them up for cheap. And even if we don't plan to be landlords for very long, we can at least sell them for a profit a year or two from now. But what they discovered was even better than flipping them is becoming a landlord and turning them into rental properties, because with the affordability crisis, we're now in an era where millions of Americans would like to be homeowners, but they can't afford it. So they need another option. And they have a family, they have reasons why they would want to have a nice big house. So why aren't there more houses available to rent? And these companies filled that need quite well, I might say. Now, it's become very controversial because as they've accumulated more and more houses, it starts to look like they're developing market power. It starts to look like my neighborhood is controlled by Wall Street. It's a very scary prospect, right? One thing that we've always liked about our housing markets, most of us, is that they're competitive. That may not be the best thing in the world when you're trying to buy a house, but if you are a tenant, you want a competitive market because it keeps the landlords from raising your prices. If they develop market power, they can act like monopolies. You don't want that. The fear here is that Wall Street is going to start to turn housing into a monopoly type market. So a lot of good economists have started to try to measure this in the last few years. The good news is that the amount of homes that these companies own are still very, very, very small compared to the size of the housing stock. They do not own nearly enough homes to have pricing power throughout the United States.
Is it like under 10%?
Yes, it is.
Yeah.
It depends how you define institutional landlord, but if we're talking about the REITs, the really big companies, yes. Now, you might, there's a great report by a couple friends of mine, Ingrid Gould-Ellen at NYU and Laurie Goodman, who's at the Urban Institute, and they kind of break down all the landlords into categories where they call the small landlords, the medium size, the big ones, and then they have the mega investors. The mega investors are the ones that a lot of people are concerned about, and they're the ones that really don't have a big market share. But if you start to include the medium-sized landlords and all that, then you do get, there's a lot of investment ownership out there, but they're not the big companies that you might think they are. There's positives and negatives to this, obviously. In some neighborhoods, they might have a little bit of pricing power if they buy up a lot of homes just within a particular neighborhood. But against that, you got to balance that they also bring a lot of positives to the neighborhood. So there's published research recently that shows that when they come into these neighborhoods, crime rates go down because they invest in things like more safety. They invest in things like increasing street light density so the neighborhood feels safer. The better landlords, and I'm not saying that all of them are good, but the better landlords do bring positive things to try to attract tenants. They're not stupid, right? They want to provide an experience that tenants are willing to pay for. And so, a lot of them are filling a need. At the end of the day, I think the real problem we're facing is we've got this housing supply shortage, which has led to an affordability crisis. The Wall Street firms are chasing that. They realize they can earn high rents because we have an affordability crisis. And in turn, they're being blamed for the affordability crisis. But when you look at Ingrid and Laurie's report, for example, what they find is that it's not that you have institutional investors coming in and then rents rise. It's that you have rents rise and then institutional investors come in. They're chasing the good markets. They're not actually driving the rent up because they're just like the rest of us. They want to live in the good places and they want to buy the good homes.
So that's trending upward, right?
Yeah.
And I don't know if you agree, but I feel like that's going to continue to trend upward.
Yeah.
The old American dream was to work hard and buy a house, right? Yeah. Do you think that dream is still alive for a lot of the younger folks that are coming to, market now?
It's definitely alive. I mean, if my classroom is any indication, when I talk to my students, the vast majority of the hands go up when I ask who wants to buy a home. And when I teach a personal finance class and I ask them, what do you want to save money for? The number one thing they talk about is buying a home. The problem is, I think it's harder to achieve than it used to be, and it's taking them longer than it used to. So my generation is the millennials. The millennials were getting, I don't know if criticized is the right word, but questioned for years. When are you going to start buying homes? Right. The last generation bought homes when they were in their 20s. When are you going to get married? When are you going to buy homes? Why are you living in your parents' basement, right? All these things they kept getting. And then around the time millennials hit their early to mid 30s, the stars aligned and a large percentage of them had saved up enough money, had paid off their student loans, the economy was doing well, and they were able to start, and all of a sudden we saw a big wave of home buying. And in fact, that happened to coincide with right when the pandemic began, and that's part of the reason why we had such a big surge in housing pricing in the early years of the pandemic. Right. Now the next generation that's coming behind them are facing the exact same problems. They will eventually buy homes. I think the problem is that a lot of them are not able to afford the homes that would offer them high opportunities for the lives that they want to lead, and it's going to take them a long time. And so, one of the things that we've gotten really good at measuring in the last 10 years or so in the economics profession is how much a location affects a person's life. And we have to thank Raj Chetty for this at Harvard. He really started it all. He got the data to follow people over time and show what neighborhood did you grow up in, what income did you wind up earning 30 years later, and piecing that together for, tens of millions of people around the United States. And what we found is that location matters dramatically. So people might be able to buy a house, but can they buy a house in the neighborhood that will be best for them? And I think what we're finding is it's harder and harder to do that. You asked, how did I wind up working with the Federal Reserve Bank of Atlanta? The main reason is because my dissertation supervisor was Raphael Bostic, who's now the president and CEO of that bank. And one of the things he has said throughout his career when he was working at HUD and the Fed and as a professor is that housing is a platform, he likes to say. It's not just a home, it's a platform, meaning it's a stepping stone that leads you to all the other things in your life. Where you lead determines where you go to school. It determines what kind of health care you have access to, what kind of jobs you have access to, whether you breathe clean air, whether you live on a safe street, what opportunities your children have access to, who they play with and who they grow up with. All of these things are determined by where you buy that house. And so we want people to be able to buy houses in the best possible places for them. And the harder we make it to do that, the harder it's going to be to close the equity gap, the inequality gap in the United States, and to have full productivity growth the way we could as an economy.
So this has been a great conversation. We're not done yet, but if you guys have made it this far, this is kind of the bonus section.
All right.
So let's get out of the U.S. a little bit. Globalization. I feel like the demands of what's happening in the world, right? A lot of dynamic things happening. You could talk about the wars, you could talk about supply, you could talk about, supply chain, all that stuff. But what's the overall pressures on the U.S. economy as it relates to what's happening globally? Can you talk a little bit about that?
Yeah. Well, we've talked a good bit about the Federal Reserve, so let's start there. I think one of the challenges that the Federal Reserve faces is that their job is to respond to the needs of the American economy. But what they do affects everybody. So these high interest rates that we've had for the last few years haven't just hurt Americans, they have hurt a lot of economies around the world. And so it's a delicate ethical and moral dilemma. If you're a Fed policymaker, to what extent do you make decisions because they're going to harm people who aren't really your constituents, right? It's not technically your problem, but you know deep down you should care about those ramifications. And I don't know how they do that calculus in their head, but that is one thing that I've been concerned about for a while. Now, at the same time that all that is happening, we've got a lot of Wall Street, and not just in America, but also China and other countries with a lot of money to investing around the world in developing nations. And those emerging markets have been accumulating a lot of debt. So emerging market debt has gotten to the point where I believe that a lot of countries are over-leveraged. And so we talked earlier about what kind of risks should we be concerned about could lead to another recession, or at least could cause some weakening economic growth that the Fed will have to respond to. I think the next big problems to occur are more likely to be overseas than in the United States.
Will that have an impact on us here?
Absolutely, yeah.
How so?
And it depends which country it is, because some countries we have stronger trade relationships with than others.
So it's trade impacts.
So it all depends on its trade and its capital flows. Right? If we've invested a bunch of money in certain countries and they start defaulting, that's going to be losses that's going to show up on our bank's balance sheets. And one of the things that I think is, when we look back on this time in history, we're going to wonder about is, why did we invest in all of these countries with such low interest rates? At a time when we're raising interest rates at home and we're so concerned about credit risk, we've been offering bonds to other countries, or we've been buying bonds from other countries at surprisingly low interest rates. I mean, the spread that's supposed to compensate investors for that exchange risk, for that emerging market risk, has been surprisingly low over recent years. And that's what allowed them to issue all that debt, because they know that they're paying us relatively low interest rates, compared to other investments throughout the world. That is a concern that I really have going forward.
So America, free capital market, capitalism, democracy, are they connected? Like you see China, it's not a free market, right? Russia, it's not a free market. Like, talk a little bit about democracy and capitalism and how they tie together.
Yeah. One of the things about both of those ideas is, I think oftentimes we fail to really explore how much of a spectrum it is. We think about, well, we have a capitalist economy, China has a communist economy. We go around the world and we label these countries. They all exist on a spectrum, right? We have a capitalist economy? What does that mean? It could mean a lot of different things, but if we mean free markets, we don't have a free market. We just talked about all the regulations that you have to follow in order to get anything done in the real estate market, right? Yeah. This is not a free market by any stretch of the imagination, and the government is a huge portion of the economy, right? A huge percentage of Americans get their income through one way or another from the government. That makes it not a free market, right? It is more free market than China, sure, but it's on a spectrum. And so I think one of the mistakes that we might make when we oversimplify this conversation is to look at a country that's all the way on the communist end of the spectrum and say, well, that's not working. And it's not, right? We've seen countries that have been fully communist and it has not turned out well for them. We then say, well, then we should go all the way to the other end of the spectrum. Well, now, wait a second. That's not necessarily true either. Another example we could use that's maybe working in the opposite direction is Russia. One of the economists who inspired me to go into the field was Joe Stiglitz. He was a Nobel Prize winner for studying. He was one of the founders of the field of information economics. He really wanted to study situations where people are involved in a capitalist transaction, but for some reason, they don't have access to all the information they need. And so somebody's going to get screwed.
Right.
And he found that there's a lot of those situations out there, and that those situations make the economy underperform and make a lot of people get hurt. So he was really frustrated when he became chief economist of the World Bank in the 1990s. And he watched some of the transition as Russia went from a communist country coming out of the Soviet Union to a capitalist country, because he felt like all of the things that he had learned in his career were completely ignored. The people at the World Bank at the time were encouraging Russia to go as fast as they could in the direction of capitalism, which in the long run may not be a bad thing. But for a country that doesn't have the democratic institutions in place to make sure that when you have a free market, it's governed effectively so that people aren't taken advantage of because they don't have the right information. If you don't have those institutions in place, instead of having a well-operating free market, you have a place where a few oligarchs take over and take advantage of everybody because there aren't the right regulations in place. Yeah. And so to this day, Russia is a fraction of the economy that it could be if it had more democratic institutions in place. I would say that nowadays, the best scholar, the best economist of the study of democracy and economic growth is an economist named Darren Acemoglu up at MIT. And he'll win a Nobel Prize for sure someday. And a lot of his work has been studying, as countries adopt more democratic institutions, does it foster economic growth? This has been an old debate that people have been studying for decades, but he's brought some new data to it and I think has been really careful about measuring it to make sure that he's actually identifying cause and effect properly. And the answer is yes. Democratic institutions do, on average, improve economic growth. And it's not just because they move you more in a capitalist direction. They don't always do that per se. It's because they ensure that when capitalism is in effect, the growth is widespread, people feel that they're benefiting, and that supports the capitalist institutions. Yeah. One of his current fears that he's been talking about just over the last year or two, after spending a lifetime studying this stuff, is that in places like the United States and places in Western Europe where we've had very robust democratic institutions, he sees a lot of those institutions under attack now. And what'll happen is, as people don't feel that capitalism has benefited them, they will erode the very democratic institutions that are designed to try to protect them and make sure that capitalism does work for them. If we erode our democratic institutions, fewer and fewer people will benefit from capitalism.
It goes back to the more of a monopoly and oligarchy. Right. Lastly, I feel like there's a trend with these, all the countries are becoming more nationalistic, right? Yeah. Less global. Yeah. But ultimately, we're all tied together globally. Yeah. So as these countries kind of condense and become more nationalistic and cut their ties with other countries, right? You see that a lot with the elections that are happening in different countries. How do you see the economy being affected by that?
Well, it's not good for the economy, but it's also not good for foreign relations. I mean, let's just be clear that while there are some downsides to the way that globalization has happened, going to the opposite situation where it's every country for themselves, it erodes a lot of the institutions that keep us from turning to things like global wars, which would be devastating for the economy, but would also be devastating for life on this planet. I am concerned that both political parties right now in the United States feel that they need to take this protectionist turn. I understand why they feel that way. I will be the first to admit that there are people throughout the United States who have been harmed by globalization. They took a job that at the time made sense, but then 10 or 20 or 30 years later, when they were midway through their careers, they suddenly found that that job was outsourced, and that wasn't their fault. And there was no new plan put in place to help them make the transition. Right. I often feel like one of the problems that we have in economics is that we are good at identifying what's the goal we need to get to, but we're terrible at figuring out the transition to get there. Yeah. We know that having a more globalized world where we all work together would be better for everybody. But along the way, there's going to be winners and losers, and somehow we forgot about the losers. We did the transition terribly. As a result, we decided to throw the baby out with the bathwater. Instead of coming up with better ways to manage globalization, to make sure that people are prepared to thrive in a globalized economy. They have the right education, they have the right job training, they live near the jobs that they can thrive in, et cetera, et cetera, et cetera. Instead of doing those things, which frankly is the harder work of being a policymaker, we're taking what feels like the easier way out, which is, screw it, we just won't be a part of the global economy. That's not going to be good for anybody in the long run.
It's not going to be good because we are tied together, I agree. And would you say that even though there's an election coming up, how much of that's going to have an impact of the economy in the U.S.?
Will the election have an effect on the economy?
Right.
Oh, it definitely will. The policies that the two parties are offering are very different. I saw Larry Summers, the famous economist, argue just a couple of days ago that he was worried when he saw Donald Trump's latest economic policies because he felt they were the most inflationary policy proposals he's seen in his lifetime. And what he was talking about was you institute a ton of tariffs and you drive up the cost of everything that everybody buys. You instigate more global warfare. You drive up oil prices and so on and so forth. I think there's an argument to be made that there are problems with some of President Biden's policies too, but he's trying to make that distinction that whoever you vote for here, they're going on very different paths, right? So Donald Trump, for example, wants far more tariffs. Some of his economic advisors have floated the idea of entirely replacing the income tax with just tariffs, which I don't know any economist who would support that idea. At the same time, the income tax system is poised to change, and so it's going to be up to which of these two presidents is going to get to see that, because the TCJA, the Tax Cuts and Jobs Act from 2017, has a whole bunch of provisions that expire soon. Those provisions are primarily the individual income taxes. So the tax cuts that we saw in 2017 are going to go away unless Congress institutes a new series of reforms to either keep them in place or change them somehow and not just let them disappear. The two parties have very different ideas about how to do that. Donald Trump and the Republicans pretty much just want to, because they were the ones who passed it in the first place, they just want to reinstate it, keep it permanent. President Biden and the Democrats, they have their ideas about how to let some of them expire, mostly for the very wealthy, and let some of them stay in place for the middle class. And if you're worried about the budget deficit, that's going to have very different implications, right? President Biden's approach would raise more revenue. Donald Trump's approach would raise less. So depending on where you fall on the political spectrum, you can take your pick there, but they are very different sets of policies.
Yeah, great summary. Last question, mid-year, where do you see us heading economically in the next year and a half?
Right now, things look good. I don't think that we're headed for any real problems over the summer, certainly. It's always harder to see further beyond that. Yeah. I think that President Biden is going to do everything in his power to make sure that the economy is humming along by November. I think that the economy is going to be one of the primary determinants of whether he gets reelected or not. And not just the economy, I would specifically say gas prices. I did some research years ago where we showed just how important oil prices and gas prices are to predicting election outcomes. And we found some evidence that presidents are pretty good at keeping gas prices low right before the election so that there's nothing upsetting people when they go to the pump. But that's harder to do at a time when you have war going on in the Middle East and in Russia, two of the major places where they can control gas and oil prices. Right. So I think that's going to be one of the things that we've got to keep our eyes on. And then, like I said, I would keep my eyes on, I always, just as a general rule for everyone out there, when I'm looking for where is the next big crisis going to come, I'm always looking for who's taking on too much debt. Because time and time again, since we've had capitalism for the last couple of 100 years, the worst recessions have always been caused by over-leverage. And even when things get a little out of whack and prices get a little too high, if people haven't taken on too much debt, there are ways to unwind those problems without it spilling over and causing a massive financial crisis. When it spills over into the banking sector, as we saw in 2008, is when we're really in trouble. So that's why I'm worried about that happening overseas. But in general, over-leverage is the real culprit that I worry about.
Thank you, Dr. Orlando.
Thanks for having me.
Appreciate it. Well, if you guys made it this far, I hope you guys enjoyed this as much as I did. Thank you for watching. another episode. Stay tuned for more content coming out. Thanks.
Thanks for tuning in to the Maestro Minute podcast. Make sure to rate this podcast if you found it helpful, share it with a friend that could use it, and follow us on all major podcast platforms. The Maestro Minute, powered by Maestro Development.